Alabama Department of Revenue. Business Essentials for State Taxpayers. Record-Keeping Learning Module.
The following video is intended to be an overview of the subject matter included and is not a comprehensive explanation of all aspects of the subject matter. The information contained in this video does not represent legal advice and is not legally binding on the department. Information regarding taxes and tax administration changes frequently and should always be confirmed through a tax professional. Please refer to the Alabama Department of Revenue website at revenue.alabama.gov for additional information.
In this lesson, we will determine why you should keep records, outline the type of records that should be kept and for how long, summarize the statute of limitations on records, and learn about penalties and interest. Record keeping is the process by which records of an organization are created, captured, maintained, and disposed of. Why should I keep records? To monitor the progress of your business, to prepare your tax returns, to keep track of deductible expenses, to monitor your basis in property, to prepare your financial statements and identify sources of income, to support items on your tax returns. The business you are in will determine the type of tax records you need to keep. Law does not specify what records must be kept. However, the following may be requested by the Alabama Department of Revenue if your return is under review: bank statements and canceled checks, credit card receipts and statements, paid invoices and statements, purchases and sales, receipts, payroll information, Z-tapes and cash register recaps, sales journal, customer tax exempt files, all untaxed sales, verified and documented, copy of sales tax certificate of exemption and/or retail certificate. This information makes up the customer tax exempt file. What is the statute of limitations? This is the period of time in which the state of Alabama can assess additional tax, penalties, and interest due. A taxpayer also has generally 3 years to claim a refund of any tax overpaid. If you failed to timely file your tax return, any refund must be claimed within 2 years from the original due date of the return. You should keep records that support an item of income or expense or deduction on a return until the statute of limitations for that return runs out. For all returns and amended returns, there is a 3-year statute of limitations from the date that you file the return. There are certain circumstances in which the statute of limitations may be extended. A few examples are as follows. If you do not report income that you should report, and it is more than 25% of the gross income shown on the return, there is a 6-year statute of limitations from the date you file the return. If you file a fraudulent return or do not file a return at all, there is no limit on the statute of limitations. If you file a net operating loss, the statute of limitations is in place until the loss is exhausted. You could be responsible for penalties and interest if you fail to timely file, if you are found negligent, or have committed fraud. Here are the various types of penalties. Interest. If the tax is not timely paid, interest is also due. The interest rate is established by the U.S. Secretary of the Treasury under authority of 26 U.S. Code 6621.